Every trader enters the market with a dream, a vision of freedom, wealth, and control over their own destiny. Yet, as the journey unfolds, that dream often becomes tangled in confusion, fear, and frustration. The market, in its purest form, is a mirror. It reflects not our intentions, but our beliefs, our discipline, and our ability to act without hesitation or emotional distortion. Consistency in trading isn't about finding the perfect strategy or the flawless indicator. It's about aligning your mental state with the realities of the market. The challenge isn't out there, it's within you. The truth is, most traders spend their time searching for external answers, a better entry signal, a new setup, or a secret formula someone else seems to know. But real consistency doesn't come from external discovery. It comes from internal transformation. When you finally understand that the market offers endless opportunities every single day, you stop trying to control it and start controlling yourself. That's when trading becomes effortless. Not because the market becomes easier, but because your perspective evolves. Every trade carries uncertainty. The outcome of any given trade is always unknown, yet the probabilities remain constant over time if your edge is real and you can execute it without interference from fear or greed. The professional understands this and trades accordingly. The amateur, however, seeks certainty where none exists. And every loss becomes personal, every win feels like validation. That emotional roller coaster destroys consistency long before the account ever does. To bring consistency into your trading, you must accept the randomness of individual outcomes while trusting the certainty of long-term probabilities. You must stop trying to avoid losses and instead learn to see them as part of a neutral, ongoing process. The market isn't against you. It doesn't even know you exist. It simply provides information. And your job is to respond, not react. Discipline, patience, and trust are not skills you build once. They are habits you reinforce every day. You train your mind the same way you train your trading plan, through repetition, feedback, and awareness. The trader who seeks to master the market will always fail. The trader who seeks to master himself will eventually find that the market bends in his favor. Consistency is not an event. It's a state of mind. It's the ability to think in probabilities, to act without hesitation, and to remain emotionally neutral regardless of outcome. These 7 golden rules are not rules in the conventional sense. They are principles designed to align your thoughts, emotions, and actions with the realities of trading when followed with genuine commitment. They transform the chaotic experience of market participation into a structured, confident, and consistently profitable process. Because, in the end, consistency isn't something you achieve. It's something you become. Mastering your mindset before mastering the market is the foundation upon which every successful trader builds their journey. Most traders enter the markets thinking that technical knowledge, chart patterns, or strategies will be the key to success. They believe that if they can just find the right setup, the perfect indicator, or the ideal entry signal, they will finally unlock the consistency they've been chasing. But this belief is precisely what keeps them trapped in a cycle of frustration and disappointment. The market doesn't reward technical brilliance, it rewards psychological balance. Until your internal world aligns with the nature of the market, every system you use will eventually fail. Not because the strategy doesn't work, but because your mindset dictates how you interpret market information. It shapes your decisions, your reactions, and even the way you perceive opportunity and risk. The truth is, the market doesn't care about your opinions, your fears, or your goals. It moves based on the collective actions of millions of participants, each responding to their own beliefs about value and opportunity. You can't control that flow, but you can control how you engage with it. The traders who consistently profit are not those who predict the market's every move, but those who can remain mentally balanced regardless of what the market does. The mind of a losing trader operates on hope and fear. When the market moves in their favor, they feel euphoric, convinced they have finally figured it out. When the market moves against them, panic and self-doubt take over. Every fluctuation in price becomes an emotional event. Every loss feels personal, and every win reinforces a fragile sense of confidence. This emotional dependence creates inconsistency. One day they follow their plan, the next they abandon it. Their mindset is reactive, not objective. They are controlled by the market instead of being in control of themselves. A trader who has mastered their mindset, on the other hand, operates from a place of calm detachment. They understand that every trade is just one of many, that no single outcome defines them, and that their edge only reveals itself over a series of trades. This mental shift is everything. It's the difference between trading for emotional satisfaction, and trading for statistical execution. The professional accepts uncertainty as part of the game. They don't resist it, they don't fear it, they embrace it. That acceptance gives them freedom. Freedom from the need to be right, freedom from the pain of loss, and freedom from the illusion of control, the journey toward mastering. Your mindset begins with self-awareness. You must learn to observe your thoughts and emotions without judgment. Every time you hesitate to take a trade, every time you exit too early, every time you hold on to a losing position hoping it will turn around, those are not market errors. They are reflections of your beliefs about pain, risk, and reward. Most traders carry deeply rooted mental conflicts. The fear of missing out, the need to prove themselves right, the unwillingness to accept loss. These conflicts distort perception when you're afraid to lose. Your mind filters market information in ways that confirm your fears. You see threats instead of opportunities, hesitation instead of clarity. You can only trade what you see, and what you see is filtered through what you believe. If your beliefs about the market or about yourself are flawed, your decisions will reflect those flaws, no matter how advanced your system is. This is why two traders can look at the exact same chart and see completely different things. One sees risk, the other sees opportunity. The chart hasn't changed. Only the internal state of mind has. To master your mindset, you must recondition the way you think about risk. Most people equate risk with danger or potential loss. But in trading, risk is simply a measure of possibility. Every trade carries both the potential for profit and the potential for loss. Once you truly accept this, emotionally and intellectually, your fear begins to dissolve. Fear only exists when you resist uncertainty, when you demand that the market behave according to your expectations, but the market owes you nothing. The moment you stop trying to control outcomes and start focusing on executing your plan flawlessly, you begin to experience the true freedom of trading. The professional trader doesn't think in terms of being right or wrong. They think in terms of probability and process. Each trade is an opportunity to express their edge, to participate in a game of numbers. When a trade loses, they don't feel defeated. It's just one data point in a long sequence. When a trade wins, they don't feel superior. It's simply confirmation that their process works over time. Their emotional state remains steady because they are grounded in reality, not expectation. That steadiness is what allows them to maintain consistency even during drawdowns or volatile markets. Mindset mastery also involves redefining your relationship with loss. Most traders see losing as failure, but in truth, losses are the tuition you pay to learn the language of the market. Every loss carries information, not punishment. If you can learn to view losses as feedback rather than threats, your emotional attachment to outcomes begins to weaken. You stop avoiding trades out of fear, and you start executing your plan with clarity. The irony is that once you stop fearing losses, you lose less. Another aspect of mindset mastery is trust. Trust in your system, trust in your preparation, and trust in yourself. Without trust, you second-guess every decision. You hesitate on entries, you cut winners short, and you let losers run because you don't believe in your own plan. That lack of trust stems from uncertainty within, not uncertainty in the market. Trust is built through repetition and consistency. The more you execute your plan with discipline, the more evidence your mind collects that the process works. Over time, your confidence becomes unshakable because it's based on experience, not emotion. Emotional control doesn't mean suppressing your feelings. It means understanding them. When you feel fear, greed, or frustration, those emotions are signals. They tell you where your beliefs and expectations are misaligned with reality. Instead of fighting them, analyze them. Ask yourself why you feel fear when a trade moves against you. Is it because you risk too much? Is it because you tied your self-worth to the outcome? Every emotional reaction points to a belief that needs examination. Through awareness, those emotional triggers lose their power over you. Ultimately, mastering your mindset is about becoming your own observer, seeing yourself in real time as you trade, recognizing when your emotions are trying to hijack your process, and choosing discipline over impulse. The goal isn't to eliminate emotion, but to operate beyond it. When you reach that level of awareness, trading becomes a process of flow. You act intuitively, yet with structure. You follow your plan effortlessly because your internal state and your trading system are in harmony. The market will always be unpredictable, but your response to it doesn't have to be master your mindset and you master your behavior. Master your behavior and you give yourself the consistency that every trader dreams of. The strategies, tools, and systems are secondary. They are amplifiers of what already exists within you. The The mindset is the engine. Everything else is an extension of it. Trading probabilities, not predictions, is the essence of professional trading. Most traders enter the market trying to forecast what will happen next. They believe that success lies in accurately predicting price movements. They study patterns, analyze indicators, and look for signals that seem to guarantee direction. But prediction is an illusion, and the more a trader depends on it, the more fragile their mindset becomes. The market is a dynamic environment driven by countless variables that no one can fully understand or control. Every tick, every fluctuation is the result of millions of decisions made by participants all over the world. To expect certainty in such an environment is to set yourself up for disappointment and confusion. Thinking in probabilities means accepting uncertainty as a permanent companion in trading. It's about understanding that you can never know the outcome of any individual trade, but you can know the likelihood of outcomes over a series of trades. A professional trader doesn't need to be right on every trade. They only need to consistently execute their edge over time. When you focus on probabilities, your mindset shifts from needing to be right to needing to act correctly. That subtle change in perspective is what separates consistent traders from emotional ones. Prediction-based thinking keeps traders trapped in emotional cycles. When they predict that a market will rise and it does, they feel smart and confident. But when it doesn't, they feel frustrated and betrayed. Their sense of control shatters. And they begin questioning their system, their analysis, and even their abilities. They start tweaking strategies, adding more indicators, or avoiding trades out of fear. This behavior creates inconsistency because their actions are always based on emotion rather than logic. A probability-based trader, however, expects randomness. They know that a loss doesn't invalidate their edge, just as a win doesn't confirm perfection. Each trade is simply one instance in a much larger statistical sequence. The principle of probabilities liberates you from the illusion of control. It allows you to view trading objectively without the need for emotional validation. The market doesn't care about your predictions, your opinions, or your expectations. It will move according to the collective belief of participants, not your analysis. When you stop trying to force the market to fit your narrative and start responding to what it actually presents, you begin to flow with it instead of fighting against it. A trader operating on probabilities understands that outcomes are distributed randomly over a series of trades. Even if your edge gives you a 60% chance of success, you cannot know which trades will fall into the winning 60% and which will fall into the losing 40%. The only way to experience the law of large numbers is to execute every trade that meets your criteria without hesitation or interference. If you skip trades out of fear or take impulsive ones out of greed, you distort the probability distribution that gives your edge its power. This is why discipline and consistency are inseparable from probability-based thinking. To truly trade probabilities, you must redefine your relationship with risk and reward. Most traders view risk as something to avoid, but in reality, risk is the price you pay for opportunity. Every trade carries risk, and without it, there can be no profit. When you accept risk as an inherent part of the process, it loses its emotional weight. You no longer fear losses because they are simply the cost of doing business. Your focus shifts to managing risk, not eliminating it. You size positions appropriately, you respect stop losses, and you never let a single trade threaten your long-term survival. When you think in probabilities, your focus expands beyond single outcomes. You stop judging yourself by individual trades and start evaluating your performance across a meaningful sample size. The emotional highs and lows of trading begin to flatten because you understand that a single trade doesn't define your success. You might lose 3 trades in a row and still be perfectly aligned with your plan. You might win 5 trades in a row and know that losses are still part of the game. This detachment creates emotional stability. And emotional stability is what allows consistency to emerge. Traders who rely on prediction often struggle with overconfidence after a few winning trades. They start increasing position sizes, taking unnecessary risks, or abandoning their rules because they believe they figured it out. This mindset inevitably leads to large drawdowns when the market turns. A probability-based trader avoids this trap because they never confuse outcome with skill. They understand that a winning trade doesn't mean they made a perfect decision. It just means the market moved in their favor this time. Likewise, a losing trade doesn't mean they were wrong. It simply means probability played out as expected. The key to applying probability thinking lies in emotional neutrality. You must train yourself to accept both wins and losses with the same level of calmness. The moment you assign emotional meaning to an outcome, you give power to randomness. When you celebrate a win too much, you subconsciously attach value to being right. When you feel pain from a loss, you reinforce the fear of being wrong. Both reactions pull you away from objective execution. The professional trader, grounded in probability, feels nothing more than acknowledgement. They review record and move on. Understanding probabilities also transforms how you see market setups. Instead of searching for certainty, you begin searching for conditions where your edge has a higher likelihood of success. You realize that no pattern guarantees profit, but that certain conditions increase the odds. This mindset removes the desperation to find perfect trades and replaces it with a calm focus on execution. You stop trying to predict the next big move and start aligning with repeatable opportunities that fit your system. This probabilistic approach extends beyond strategy. It becomes a philosophy. It teaches you patience, humility, and respect for randomness. You stop arguing with the market. You no longer chase missed moves or revenge trade after losses. You simply follow your plan and let the numbers play out over time. The longer you operate in this state, the more consistent your results become, not because you've found a way to predict the future, but because you've learned to operate effectively within uncertainty. Many traders resist this idea because it seems counterintuitive. They think trading without prediction means giving up control. But in reality, it's the opposite. When you stop predicting, you gain control over the only variable that truly matters, your behavior. You begin to understand that your job isn't to know what will happen next, it's to manage what happens when it does. You take trades based on probability, manage risk, and let the market do the rest. The less you try to control outcomes, the more control you actually have. The mental discipline required to think in probabilities doesn't develop overnight. It requires conscious effort to break free from the conditioning that values being right over being consistent. You have to detach your identity from your trades and accept that success in trading is not about accuracy, but about execution. A trader who wins 40% of the time can be more profitable than one who wins 80%. If the first trader manages risk better and sizes positions properly, the numbers don't lie, but emotions do. And emotions are the byproduct of prediction-based thinking. The more you train your mind to see trading as a probabilistic process, the calmer you become. You start approaching each trade as just another opportunity to express your edge. You no longer panic when the market moves against you or become euphoric when it moves in your favor. You act with balance, consistency, and confidence. Over time, this perspective becomes second nature. You stop asking, will this trade work? And start asking, does this trade fit my edge? That single shift in thinking is what elevates an ordinary trader into a professional one. Detaching emotionally from individual trade outcomes is one of the most difficult but essential transformations a trader must make to achieve consistency. Every trade carries emotional weight for those who have not yet learned to separate their identity from their results. When a trade wins, there's excitement, validation, even pride. When it loses, there's frustration, doubt, and sometimes anger. This constant swing between emotional highs and lows creates instability in both mindset and decision-making. A trader trapped in this cycle can never truly be objective because their actions are always influenced by how they feel rather than what they know. Emotional attachment clouds perception, disrupts discipline, and slowly erodes confidence. The market, in its purest form, is neutral. It doesn't care who wins or loses, and it doesn't reward effort or punish laziness. It simply moves according to the collective actions of all participants. The meaning you assign to those movements comes from within you. When you attach emotion to every outcome, you distort that neutrality and begin to project your personal fears and desires onto the market. You stop trading what's in front of you and start trading what you want or need to see. This disconnect between reality and expectation is where inconsistency begins. Detachment doesn't mean indifference or a lack of passion. It means being emotionally balanced, fully engaged in the process, yet unaffected by any single result. The professional trader treats each trade as a single event in a much larger series. They understand that any outcome, win or loss, is merely the manifestation of probability. Their sense of self-worth, confidence, and peace of mind are not tied to whether a trade succeeds or fails. This mental separation allows them to act decisively, without hesitation or regret, because their decisions are guided by process rather than emotion. To detach emotionally, you must first understand why attachment exists. At its core, emotional attachment comes from unmet psychological needs, the need to be right, the need for certainty, and the need for validation. Many traders subconsciously use the market as a mirror to reflect their self-esteem. When a trade wins, they feel intelligent and capable. When it loses, they feel inadequate. The market becomes an emotional battlefield where every outcome reinforces or threatens their self-image. This dependency creates volatility, not only in their accounts, but also in their emotions. The moment you begin to measure your value as a person by the success of your trades, you lose the ability to see the market objectively. Emotional detachment starts with redefining what a trade means. A trade is not a test of intelligence, nor is it a statement about your ability to succeed. It's a single instance of opportunity where you applied a plan based on probabilities. The outcome of that event has nothing to do with your worth as a trader or as a person. Once you truly internalize this truth, your emotional reactions begin to lose intensity. A losing trade becomes feedback, not failure. A winning trade becomes confirmation of process, not proof of superiority. The root of attachment is expectation. Every time you place a trade with an expectation of what should happen, you create emotional tension. When the market meets your expectation, you feel rewarded. When it doesn't, you feel punished. But the market isn't capable of rewarding or punishing. It simply is. It doesn't know about your entry, your stop loss, or your target. It's indifferent to your analysis and your conviction. The only thing that can create emotional pain in trading is your own attachment to a desired outcome. By releasing the need for the market to do what you want, you remove the source of that pain. A trader who is emotionally detached approaches each trade with a sense of curiosity rather than demand. They observe how their system interacts with the market's randomness. They don't label outcomes as good or bad. They see them as part of a continuous flow of probabilities unfolding over time. This perspective allows them to remain calm even when they experience consecutive losses, because they know their edge will eventually play out if they continue executing correctly. Emotional detachment gives them the stability to endure drawdowns, the patience to wait for setups, and the clarity to follow their plan without interference. One practical way to build emotional detachment is to reduce the importance of individual trades. The more significance you assign to one outcome, the more emotion you attach to it. Start thinking in terms of series rather than single events. For example, view every 20 or 50 trades as one set. Within that set, there will be winners and losers, but what matters is how the overall performance aligns with your edge. This broader perspective diffuses emotional pressure. You stop obsessing over one result because you know that consistency emerges from repetition, not perfection. Risk management also plays a critical role in emotional control. When you risk too much on a single trade, you magnify its emotional impact. Your mind perceives the trade as a threat because the potential loss feels too painful. This triggers anxiety, hesitation, and impulsive decision-making. By keeping risks small and consistent, you create psychological safety. Each trade becomes just another opportunity, not a life or death event. The smaller the emotional stakes, the easier it becomes to remain neutral. Another step toward detachment is acceptance. Accepting that losses are inevitable, that uncertainty cannot be eliminated, and that no strategy will ever produce perfect results. The desire for certainty is what fuels emotional turbulence. When you accept uncertainty as part of the process, your expectations align with reality and emotional resistance dissolves. Every trade becomes a simple execution of your plan, free from the weight of emotional demand. Awareness is equally important. Emotions don't disappear simply because you wish them away. You must learn to observe them. When you feel frustration, fear, or excitement during trading, take a moment to identify the thought behind the feeling. Ask yourself what belief is being triggered. Are you afraid of losing because it threatens your sense of competence? Are you excited about a win because it makes you feel superior? Awareness transforms emotions from forces that control you into signals that guide you. Each emotion reveals a belief that may need to be reprogrammed. Emotional detachment is not built overnight. It requires deliberate practice and repetition. You must train your mind to remain neutral through both winning and losing streaks. Journaling your trades helps by allowing you to record not only your technical observations, but also your emotional states. Over time, patterns will emerge. You'll start recognizing how certain emotions consistently lead to impulsive behavior. By bringing awareness to these patterns, you weaken their influence. Visualization is another powerful tool. Before trading, visualize executing your plan perfectly. Not winning, not losing, but following your process with precision. Picture yourself remaining calm regardless of outcome. This mental rehearsal conditions your mind to associate peace with discipline rather than outcome. The more you reinforce this pattern, the easier it becomes to act without emotional interference. When you reach a point where you can lose a trade and feel nothing more than curiosity, You've achieved a level of mastery few ever reach. That neutrality is not a lack of emotion, but a sign of deep trust. Trust in your edge, trust in your discipline, and trust in the law of probabilities. You understand that your value doesn't fluctuate with your P&L, and your confidence doesn't depend on the last trade. You're no longer chasing emotional satisfaction. You're executing a professional process. The irony of emotional detachment is that it doesn't make trading cold or mechanical. It makes it more peaceful and precise. You begin to see patterns with greater clarity, make decisions with more confidence and experience, the market without internal conflict. You stop reacting and start responding. You become the observer of your thoughts, not their victim. Every trade becomes a simple action aligned with a plan, unaffected by fear or euphoria. The outcome no longer defines you because your identity is grounded in your process, not your results. Following your process with discipline and trust is the cornerstone of consistent trading. Every successful trader eventually realizes that the market does not reward intelligence, complexity, or prediction. It rewards consistency and execution. You can have the most refined system in the world, the most accurate indicators, or the best analytical tools, but if you lack the discipline to follow your process faithfully, none of it matters. The difference between a professional and an amateur rarely lies in knowledge, it lies in behavior. The professional does the same thing every day with unwavering commitment, while the amateur constantly changes direction, seeking shortcuts or emotional relief. Trading is not about knowing more. It's about doing what you already know with precision and consistency, even when your emotions are screaming for you to do otherwise. Discipline in trading begins with having a clearly defined process. A process means having structure, rules for entry, exit, risk, and position size, as well as a framework for evaluating performance. Without structure, every decision becomes subjective, and subjectivity opens the door for emotion. Most traders don't actually lose because their strategy is bad. They lose because they abandon their plan the moment the market tests their patience or challenges their confidence. They take trades that don't fit their criteria, move stops out of fear, close winners too early out of greed, or overtrade trying to make back a loss. All of these actions stem from the inability to follow a process under emotional stress. Discipline is what bridges the gap between potential and performance. Following your process means doing the right thing even when it feels uncomfortable. There will be times when every fiber of your being wants to break your rules, when the market looks like it's sure to reverse, or when you're certain that holding just a bit longer will make the loss disappear. These are the moments that separate traders who survive from those who disappear. The disciplined trader acts based on plan, not impulse. They trust their system because it's been tested, and they trust themselves because they've trained their mind to execute without interference. Discipline is not about suppressing emotion. It's about acting in alignment with logic despite emotion. Trust is what gives discipline its strength. You can't follow your process if you don't trust it. That trust must be built through evidence, through backtesting, journaling, and consistent execution. When you have seen your edge play out over hundreds of trades, when you have experienced both drawdowns and recoveries, trust becomes instinctive. Without trust, discipline becomes forced and fragile. You might follow your plan for a while, but the first string of losses will shake your confidence. And you'll start questioning everything. You'll change systems, adjust indicators, or abandon setups that are statistically sound simply because the short-term results don't align with your expectations. The market will test your belief in your edge repeatedly. And without trust, you'll crumble under that pressure. Trust in your process also means understanding that losses are not violations of your edge. They are part of it. Every system, no matter how powerful, contains both winning and losing trades. The disciplined trader accepts this reality without emotional resistance. They know that their process doesn't need to win every time. It only needs to be applied consistently, enough for probabilities to work in their favor. Each trade is just a data point in a long series, and deviating from the plan disrupts the mathematical advantage they've worked hard to establish. When you act outside your system even once, you create uncertainty not in the market but in yourself. You begin to lose the ability to trust your future results because you've blurred the boundary between strategy and impulse. True discipline requires preparation. You can't expect to act calmly and consistently in live market conditions if you haven't trained for it mentally and technically. Preparation builds confidence, and confidence fuels execution. A disciplined trader reviews setups before the trading day begins, defines risk in advance, and visualizes both possible outcomes, winning and losing, without emotional charge. By the time they enter a trade, they've already accepted every scenario that could unfold. There's no surprise, no panic, no hesitation. In contrast, the undisciplined trader reacts to every tick as if it holds personal meaning. They chase candles, adjust stops mid-trade, and interpret random fluctuations as signals. Their lack of preparation forces them to trade emotionally, not strategically. The greatest challenge to discipline is internal noise, the constant dialogue of fear, doubt, and hope that runs through the trader's mind. Discipline is not about silencing that noise, it's about refusing to let it dictate your behavior. When fear tells you not to take a valid trade, you take it anyway. When greed tells you to hold past your target, you close it as planned. When impatience tells you to trade just to feel productive, you stay still. Each time you act in accordance with your process instead of your emotions, you strengthen your discipline. Over time, that mental muscle grows and execution becomes natural. You stop negotiating with your rules because you've learned that deviation always costs more than obedience. Discipline and trust are inseparable. Trust provides the emotional foundation that keeps discipline steady during difficult periods. You cannot trust your process without understanding it deeply, and you cannot understand it without experience. This is why many traders fail early. They rely on borrowed strategies without taking the time to make them their own. They follow others' rules without understanding the logic behind them. So when the inevitable losses come, they lose faith and abandon the plan. Real trust comes from internal conviction, not external confirmation. You must know why your system works, how it behaves under different conditions, and what its limitations are. Only then can you follow it with calm certainty, even when it seems to fail temporarily. Part of following your process with trust is accepting boredom. The most successful trading often feels uneventful. It's about repeating the same actions day after day, executing your edge over and over, waiting patiently for the probabilities to align. There's no excitement in routine, but that's where real consistency is born. Many traders crave stimulation. They want to feel engaged, challenged, and emotionally charged. This craving leads to overtrading and impulsive behavior. The disciplined trader understands that boredom is a sign of mastery. It means they are no longer emotionally dependent on the outcome of a trade. They are focused purely on execution. Another crucial aspect of discipline is accountability. You must hold yourself responsible for every action, every deviation, every result. It's easy to blame the market, the news, or volatility, but those excuses destroy growth. Every outcome is a mirror of your decisions. A disciplined trader reviews their performance not to celebrate wins or lament losses, but to identify whether they followed their plan. If they didn't, they correct it, not emotionally, but methodically. Accountability reinforces trust because it builds evidence that your process, when followed, produces consistent results. Fear is the enemy of discipline, and uncertainty is its trigger. You cannot eliminate uncertainty from trading, but you can eliminate your fear of it through trust. Every time you hesitate to act according to your plan, it's because you don't fully trust either the plan or yourself. Building that trust requires facing fear repeatedly until your brain learns that uncertainty isn't danger, it's just part of the process. The disciplined trader acts not because they know what will happen, but because they've accepted that knowing isn't required. Their edge doesn't depend on prediction, it depends on consistency. Over time, following your process with discipline and trust transforms your relationship with trading entirely. The anxiety fades, the impulsive decisions stop, and the need for control dissolves. You begin to experience trading as a structured, almost meditative practice. You trust your preparation, you trust your system, and most importantly, you trust yourself to act according to your rules no matter what the market throws your way. That state of inner steadiness becomes your true edge, the one that never fails, never fades, and never depends on luck. Consistency is built through repetition and self-awareness. Trading is not a one-time act of brilliance or a lucky streak that changes your life. It's the disciplined repetition of correct behavior over time. Every consistent trader understands that mastery in the markets doesn't come from occasional success, but from doing the right thing again and again until it becomes part of who you are. The market doesn't reward sporadic effort. It rewards sustained discipline. Consistency is not an external achievement. It's an internal transformation that happens when your beliefs, emotions, and actions align with your trading plan. Repetition builds skill, and self-awareness ensures that repetition moves in the right direction. Repetition is how you train both your mind and your behavior. Every time you execute your strategy according to plan, you reinforce a mental pattern. You teach your brain that discipline leads to safety and that structure creates freedom. This process reshapes the neural pathways that once reacted impulsively to fear or greed. Through repeated execution, you replace emotional reactions with automatic discipline. The challenge is that most traders never reach this stage because they fail to stick with one process long enough for repetition to take effect. They jump from one system to another, constantly chasing novelty instead of mastery. True consistency demands staying committed to one process long enough to internalize it completely. The market constantly tests your patience and focus. It tempts you to break your rules, to act on impulse, to believe that you can outsmart randomness. Repetition is the armor against that chaos. When you've practiced your process enough times, your actions become reflexive. You no longer think about whether to take a trade or not. You simply execute because your plan dictates it. Just like an athlete who trains until movement becomes instinct, the disciplined trader reaches a point where execution flows naturally. There's no hesitation, no negotiation with emotion, only repetition of what works. But repetition without self-awareness can easily turn into stagnation. Many traders repeat the same mistakes over and over, confusing activity with progress. They continue to act impulsively, ignoring the emotional triggers that lead them astray. Self-awareness is what transforms repetition from mechanical action into purposeful refinement. It's the ability to observe yourself in real time, to notice when fear begins to rise, when greed whispers in your ear, or when frustration urges you to take revenge trades. Awareness is the mirror through which you see your psychological patterns clearly, and once you see them, you can change them. Self-awareness begins with observation, not judgment. You must learn to watch your thoughts, emotions, and behaviors during trading without labeling them as good or bad. Every reaction you have in the market is feedback about your internal state. When you hesitate to enter a setup you've seen 100 times, it's not the market that's changed, it's your belief about risk or loss in that moment. When you hold a losing trade hoping it will turn around, it's not your system failing, it's your inability to accept being wrong. These are not technical issues, they are psychological ones, and self-awareness is the tool that brings them to light. Consistency requires that you become both the trader and the observer. As a trader, you execute your plan. As an observer, you study how you executed it. Every trade becomes data, not just about your system, but about yourself. You note not only the entry, exit, and result, but also your mindset during the trade. Were you calm or tense, focused or distracted, confident or doubtful? Over time, this record reveals your emotional tendencies, your strengths, and your blind spots. Self-awareness turns experience into wisdom. Without it, you may repeat actions endlessly but never grow. Repetition and self-awareness together create feedback loops. Each trade you take provides information, and through awareness, you process that information to make small adjustments. You refine your plan, your reactions, your habits. You notice which thoughts lead to hesitation, which emotions cause overtrading, and which behaviors align with success. Then you correct, adapt, and repeat. This continuous cycle of repetition and reflection is how true consistency emerges. It's not about never making mistakes, it's about reducing the frequency and intensity of those mistakes over time. Consistency also requires patience. You cannot rush transformation. The human mind doesn't rewire overnight. Every time you act according to your plan instead of your emotion, you strengthen a neural pathway that supports discipline. Every time you give in to impulse, you reinforce a pattern of inconsistency. Over weeks and months, these tiny decisions accumulate. The mind learns through experience, not words. You can read every trading book ever written, but until you repeatedly apply what you know with awareness, nothing changes. The market becomes your teacher and every trade becomes a lesson. To build consistency, you must also embrace boredom. Successful trading is repetitive by nature. It's not glamorous and it rarely feels exciting. Many traders mistake boredom for stagnation, but boredom is actually the sign of stability. When you've practiced your process so many times that it feels routine, it means you've reached a level of emotional control where the market no longer dictates your mood. You are no longer chasing the thrill of winning or running from the fear of losing. You are simply executing. That repetition may feel monotonous, but it's where mastery begins to take shape. Self-awareness deepens when you begin to notice your internal resistance to discipline. Sometimes, even when you know exactly what you should do, a part of you still resists. That resistance often comes from fear, the fear of missing out, of being wrong, of losing. It also comes from old habits built over years of instant gratification. Trading forces you to confront these deeper patterns because it exposes them instantly. There's no hiding from your impulses when money is on the line. Through awareness, you begin to see these patterns as separate from your identity. You realize that you are not your fear, not your greed, not your impulses. You are the one observing them. This realization gives you control. Repetition also builds resilience. The more you experience market fluctuations, the more emotionally stable you become. After enough repetitions, you stop reacting to every tick or trade as if it were a verdict on your skill. You begin to see that nothing in trading happens in isolation. It's all part of a larger statistical process. That understanding brings emotional calm. When you've been through enough drawdowns and recoveries, you no longer fear them. You've seen the cycle enough times to trust it. This trust is not built through theory, it's earned through repetition. Many traders fail to build consistency because they confuse short-term performance with long-term progress. They measure success by immediate results instead of consistent behavior. The truth is, your results will always fluctuate, but your process must remain steady. Repetition ensures that your actions are aligned with your plan, while self-awareness ensures that your mindset supports those actions. Together, they create internal consistency, the kind that produces external results naturally over time. Self-awareness also brings humility. The more aware you become, the more you realize how much of trading happens inside your own mind. You stop blaming the market, the system, or external factors. You begin to see that every outcome is a reflection of your choices. That realization can be uncomfortable at first because it removes excuses, but it's also liberating because it puts control back in your hands. When you understand that consistency depends on you and not the market, you stop searching for certainty outside yourself and start cultivating stability within. Repetition and self-awareness are not glamorous concepts, but they are the quiet engines of mastery. Every great trader has built their success through these two principles. They repeat what works until it becomes effortless, and they observe themselves deeply enough to correct what doesn't. Consistency isn't about perfection, it's about progress. Each trade you take, each moment of awareness you cultivate, moves you closer to becoming the trader you aspire to be. The process is gradual, often invisible, but unstoppable once it begins. Through repetition, you develop skill. Through self-awareness, you refine it. And together, they create a level of consistency that no amount of luck or prediction can ever replace.